Hi, very good afternoon to all of you. If you look at global headlines, they continue to be kind of mixed with little bit of negative tinge. Is the world facing recession? Answer is yes. The probability is increasing. In Europe, it is little bit on the higher side thanks to the Russia-Ukraine crisis. But even in North America, the probability remains reasonably high. Inflation continues to remain above 10-year average in most of the countries. Only exceptions are countries like China, where data is not reliable. As interest rate starts moving up to control inflation, the cost of servicing keeps on increasing. A 1 percentage point increase in interest payment can cost significantly to corporates and leveraged borrowers. The central bank's game of raising interest rates and taking out liquidity could have worked, provided there was no financial crisis. Unfortunately, SVB Bank in US, Credit Suisse in Switzerland are indicating that there is a cost for raising interest rates and taking out liquidity to control inflation. This fear of financial contagion is likely to impact global central banks' decision making. In US, inflation continues to remain higher level on both core as well as non-core. Fed has raised interest rates, but they have to pump liquidity thanks to SVB crisis. They took out $625 billion of liquidity since the beginning of tightening somewhere in the middle of 22. But thanks to SVB crisis, in just few days, they have added back $370 billion. The banking failure like SVB is making life of US Fed very, very difficult. It is not surprising because every time Fed has raised interest rates, it has created financial accident, whether it was Latin American debt or Russian crisis or SVB crisis. Fed's raising interest rates invariably creates financial accident. This time, smaller banks in US is in a bigger trouble. They seem to be more vulnerable to rising interest rates. The SVB crisis has ensured that financial stress is at a higher level in US market. And it's not surprising because every time Fed has raised interest rates, there is some financial accident or otherwise. Now, market expects Feds to raise interest rates by 1 time. The upper bound of Fed rate might settle between 5/4 or 5/2, but market is expecting Fed to start cutting rates by middle of 23, and by December 23, Fed fund should be on the lower side compared to what it is today. The earnings yield on US stock is now coming closer to Fed funds rate. That means debt and equity is becoming equally attractive. The problem for Fed or US continues to remain same. US has higher debt and inflation number, and unfortunately for them, lower growth and lower real interest rates. In fact, interest rates are negative, and that is their bigger problem. The Fed is caught between devil and deep sea. On one side, they are hiking rates to control inflation that is hurting leveraged American economy and creating crisis like Silicon Valley Bank. On the other side, they have to pump liquidity to ensure that SVB doesn't become a contagion, and that in turn fuels inflation. Fed is truly caught between devil and deep sea. The Indian economy remains oasis in the global desert, but there are some dark clouds gathering on our horizon. The headlines in March 23 remains fairly optimistic. Exports crossed $750 billion. Factory output was up 5.2% in Jan 23. Fast tax collection grew 46% to 50,000 crore. Headline inflation remained above RBI's target level of 6%. And trade deficit started moderating in Jan as well as Feb 23. India continues to remain one of the big defense importer, but to some extent it is balancing by exporting defense equipments. Railway cargo loading was highest for fiscal 23. Manufacturing PMI continues to remain in positive territory. So invariably, India had more positive headlines in March 23. Activity is at all-time high. Capacity utilization is above historical average. GST collection remains above 1.5 trillion, which is a positive sign for government's budget. The government is spending more money on infrastructure, and the capital expenditure as a percentage of GDP is likely to be around 3.3% for FY24. Private sector has started talking about new investment. Obviously, there is a slip between cup and a lip, but at least private sectors are now talking about new investments. Private sector is in a position to convert their intention to action, as capex to depreciation has come down at a low level. From this point, hopefully there will be revival in private sector investment as their balance sheet has become fairly deleveraged. Agriculture growth has been severe for India in recent past, but this time there is a fear of El Nino. Today, SkyMet announced that Indian monsoon will be about 94% of its long-term average in the month of June, July, August, and September 23. Now, 94% is not a bad number compared to what was the expectation. But please remember, this forecast comes with plus or minus 5% deviation. 94 plus 5 will be a good news for Indian economy, but 94 minus 5, a 10-11% drop in long-term rainfall will certainly bad for Indian economy as well as agriculture sector. Consumer sentiments, which collapsed post-COVID, have started improving, but continues to remain below pre-COVID level. We had seen that for almost last 5 quarters, rural economy was witnessing negative volume growth. People were buying smaller denomination packets. Instead of buying 10 biscuit packet, people were buying 8 biscuit packet because of inflation and because of impact on their earnings. Now it seems that consumer spending has started picking up in Jan, Feb and March 23 quarter. Sales of regular packs has started improving in both cities as well as tier 1 town. And in many categories like beverages, commodity, packaged foods, home care, personal care, March 23 number seems to be better than overall number. There is also improving trend in India's productivity as we build global level infrastructure, which is helping improve our productivity. Bank credit growth has started moderating on a higher base, but still remains in double digit for non-food and personal loans. Industrial credit has dipped a little to high single digit, but hopefully it should get revived in FY24. Indian banking system is in a robust position compared to global counterparts. The tier 1 or capital adequacy ratio remains good. NPA levels remain low as well as fully provided for. And hence, this time, banking system will have resources to support India's growth. Trade deficit was running fairly high in November and December 22 period. Our deficit was running upwards of $20 billion. And we had highlighted repeatedly that this needs to come down. Thanks to reduction in oil prices as well as gold imports and increase in services exports, this time trade deficit has come below $20 billion. This $5 billion a month reduction in trade deficit, if sustained on an annualized basis, could take out $60 billion from trade deficit. That will be something which will be very positive for Indian economy and rupee. Inflation continues to remain higher than RBI's target range for the month of February 23. But for FY24, RBI is expecting inflation to come below their target range upper level of 6%. Their expectation is that inflation will be averaging somewhere around 5.2% for FY24. Of course, inflation trajectory will depend upon El Nino as well as what will happen to oil prices. Very recently, we saw that OPEC cut oil production by more than 1 million barrels and ended up pushing oil prices to $85 from about $75, $80. Clearly, oil and monsoon, we have to watch as it can impact India's inflation in a meaningful manner. El Nino is developing. On 15th of April, we will get full details about severity of El Nino's impact on Indian monsoon. But the first forecast released by SkyMet today suggests that our monsoon will be little below average at 94% of long-term average. The spatial distribution of monsoon also has an impact on agriculture. And these projections also come with plus or minus 5% deviation. We have to wait and watch for Indian Meteorological Department's forecast, which hopefully will come after taking into account 15th April temperatures in Pacific Ocean. The real challenge for us remains recovery. It is a K-shaped recovery where rich and upper middle class are spending money, but the lower middle class and poor people are getting impacted by inflation and post-COVID events. If you look at premium gold jewelry, that's growing at a reasonable pace, but a value item like parachute coconut oil of Marico is actually showing negative growth. If we look at higher end Royal Enfield bike, it's showing positive growth. But if we look at entry-level bikes, it's showing negative growth. If we look at SUVs, they are showing positive growth. There is 1 year waiting period for many popular models, but the hatchback, the entry-level cars are showing negative growth. Luxury houses are witnessing higher growth. Affordable houses are witnessing lower growth. Premium liquor brands are getting sold at a higher value in terms of year-on-year growth, whereas popular brands are witnessing negative growth. Clearly, there is a K-shaped recovery where rich and upper middle class is spending money, but the lower middle class and poor is not spending money as before. We can't run the car just on the consumption of rich and upper middle class. We need to ensure that the poor and bottom of the pyramid also participates in this journey. Finally, as economy, we have to take tough decisions. The future of country is dependent upon how we invest in education, arts, sports, culture, and youth. If we look at the growth of central plus states expenditure on education, arts, sports, culture, youth, it's about 10.76%. But if we look at expenditure on pension, it is about 13% growth. If we are going to spend more money on pension and less money on education, clearly that's going to impact our future growth trajectory. How do we balance between economy versus election kind of situation? Converting that broadly positive economic trajectory into market. If you remember, we have been bullish about capital goods for last 1.5 years. Last year, capital goods was one of the best performing sector. We also mentioned that in the run-up to election, consumer staple should outperform the market. That also happened with a rally in Jan-Feb-March 23 quarter, with consumer stocks delivering second best performance. We were kind of little bit underweight on the metals and technology side, and both of them have underperformed the market last year. If you look at India's PE ratio vis-a-vis its competitors, it continues to remain at a premium. China trades at almost half the valuation of India, and compared to countries like South Korea or Taiwan or China or emerging market Asia, India continues to remain expensive vis-a-vis rest of the market. However, we have started seeing some positive flows in the month of March 23. The big chunk was GQG funds investment in Adani Group of $2 billion, almost $2 billion. But now we are seeing a lot of inquiries coming from our overseas investors. And hopefully we are seeing now slowdown in FPI selling. And somewhere towards the second half, we should see FPI turning buyer into Indian equity. If we look at FPI's investment in India, the sovereign wealth funds and government entities have about $10 trillion of AUM. Our share in their market or their investment should be about 3%, but currently they are only invested about 1%. If their allocation to investment goes in line with global market share in GDP, then this number should probably triple from here. The same thing is in pension funds. Same thing is true in endowment funds. Put together, India remains underrepresented in global investors' portfolio compared to its market share in global GDP. Hopefully, this consideration will allow investors to come to India on a longer term basis. We continue to trade near our historical averages. 1 year forward PE ratio has now come down to about 17.5 times, marginal premium to long-term average of about 17x. On a price to book basis, we are trading at about 2.8, marginal premium to our long-term average of 2.6. We used to trade at a significant premium to our peers on MSCI. From about 150% kind of premium, we have now come down to 82%, which is somewhere around our long-term average of 59%. Little bit of time correction or little bit of correction in our market, and we will be at similar level as our historical premium to our peers. Obviously, the biggest driver for stock market will be the results season. For the March 23 quarter, what kind of results companies give? As of today, Street is expecting about 15% earnings growth, but a lot of this will be driven by banking sector. If we remove underperforming sectors like metals and oil and gas, then earnings growth will be healthy at about 31%, driven mostly by financials. Domestic investors continue to play an important role. In most emerging market, FPIs find easy entry. They throw money and buy shares, but they find difficult exit. In many markets, when you try to sell, prices correct significantly. In markets like China, when you sell, you are not allowed to take money out. But fortunately, in Indian market, there is easy exit. Between October 21 to June 22, FPI sold 255,000 crore worth of equity and it could easily be taken out. The impact on prices was just around 10%. In India, entry is difficult. The same FPIs came to buy just about 94,000 crore of equity, and boom, market recovered almost all the losses. 2,55,000 crore taken out, market down only 10%. You brought 95,000 crore and market went up and recovered all the losses. This is showing to FPIs that in India, exit is easy, but entry is difficult. This will play a role on their investment flows. Valuation-wise, Indian markets are at neutral level, and every correction is an opportunity to increase allocation to equity. Our market cap to GDP ratio is now 94%, almost, at a little premium to our historical average of 79%. The EPS estimate for Nifty has been revised downwards. It has been seeing some sort of bottoming out for FY24 at 981 rupees earning per share. And for FY25, the street estimate is about 1,078. We believe from here till May 24, Indian equity markets will have a up as well as down move. The market will be driven by global events like US recession, Russia-Ukraine war, when will Fed stop hiking rates and start cutting rates, and what happens to energy prices. Also domestic events like when RBI stops hiking rates, when RBI pivots, what will be March 23 quarterly results and thereafter, and most importantly, what will be general election results in May 24. Put together, these events will continue to... Avinash, can you go back? Yeah, thank you. Put together, these events will continue to make an impact on our market. Some events will be positive, some events will be negative, and that will continue to have an impact on market on up as well as down. If you have to take a call, do remember that almost from November 21 to March 23, Nifty is stagnant or constant. It has gone up in recent last few days, but otherwise market is hovering around 18,000 Nifty since August 21 till April 23. In the time, EPS has gone up, P ratio has come down. So while market hasn't given much return in last 2 years, the fundamentals of market has improved over last 2 years and set the stage for better return in the days to come. Our recommendation remains same like before: marginal overweight large cap, marginal underweight small and mid cap, and use correction as an opportunity to increase allocation to equity. This remains a market of buy on dips. If we look at equity market from a fund management point of view, it's clearly a market for SIP or STP for a long-term investors. There is a lot of talk about Indian mutual funds manager not generating alpha, but very rarely people talk that even someone like Berkshire Hathaway's Warren Buffett have underperformed the market for last 10 plus years. Mr. Warren Buffett has been underperforming S&P 500 for last 10 years plus. That's something which one will have to keep in mind while evaluating fund managers' performance. If you look at our funds portfolio, most of our funds have delivered positive value add over benchmark indices to our investors. There are funds like small cap where the alpha generation is very, very high into double digits. There are funds where alpha generation is high single digit, like EQ Contra Fund or Infra and Economic Reforms Fund. And then there are funds where alpha generation is in high single digit, where rest of the funds have delivered high single digit return. If you look at hybrid or other kind of funds, the alpha generation is in mid single digit to high single digit. If you look at the point-to-point rolling returns on our funds on a 6-month basis, 1-year basis, 2-year basis, 3-year basis, 5-year basis, all the funds have delivered positive alpha to investors. Same thing across most of our hybrid funds, positive alpha across time periods. In terms of point-to-point returns, again, majority of funds are delivering positive alpha despite various limitations. Same thing across variety of other hybrid and other funds. Limited point, Kotak mutual funds, most of the funds are adding value to investors on SIP, on point-to-point return, or on rolling return. Kotak Flexi Cap Fund, which had a slightly lower than expected performance on a 3-year basis, has bounced back quite nicely. And now, thanks to that bounce back in last 1.5 years, the overall numbers have started improving. Please remember, this is the largest equity fund with more than 35,000 crore of AUM, and yet the fund is outperforming benchmark indexes quite comfortably and delivering double-digit return over a longer period of time. Kotak Multi-Cap Fund, it has generated alpha of almost 4% since its launch couple of quarters ago. It is an ideal blend of large, mid, and small cap, and it's appropriate for a customer's portfolio who doesn't want to divide between large, mid, and small on his discretion. Coming to debt market, well, US Fed, whether it is Dove or Hook, no one knows. Their inflation remains elevated, and that's putting pressure on Fed in terms of raising rates. Fortunately for India, unlike 2013, this time real rates are in our favor. We continue to have 3.4% premium in terms of real rate over US interest rates. This should bode well for our rupee from a capital flight point of view. RBI has hit pause button in monetary policy, and as Honorable Governor mentioned, it is a pause, not a pivot. We believe RBI will take a view based on developments and data coming in for the next monetary policy. Liquidity in Indian banking system has declined significantly, but RBI has managed liquidity quite nicely through open market operation. The 10-year yield has started declining as RBI paused in their rate hike cycle of more than 250 basis points. We believe 10-year yield should remain range bound between 7 to 7.5% in the days to come. We still believe the opportunity of carry and limited price impact is in 3 to 7 year segment. This time in government securities market, there was a mysterious buyer of about 1,50,000 crore. We don't know the identity of this player. As long as this kind of buyer comes and supports our government securities market, yields will remain under control. If this mysterious buyer is not present next year, then RBI will have to play Secret Santa. In the debt market, the tax benefits are gone from 1st April 2023 for long-term capital gain stroke indexation. but other benefits continue to remain for investors. For example, there is anytime liquidity in most debt funds except FMPs. These debt funds are managed by professional managers who manage interest rate risk quite nicely. With as little investment as 1,000 rupee, one can get diversification over 30, 40, 50 instruments, which is not possible otherwise. And more importantly, in mutual fund, you pay tax on redemption. So there is deferment of taxes. About a 8% yielding security for a 39% taxpayer could result into extra return of 0.5% plus thanks to deferment of taxes. So overall, while tax benefits are gone, there is anytime redemption facility in most debt funds. There is professional management for credit risk and interest rate risk. There is diversification across 30 to 50 instruments with as little investment as rupees 1,000. And there is deferment of taxation for high net worth individuals. If you look at dynamic bond fund, where fund manager takes a call based on his view on interest rates, then certainly Kotak Dynamic Bond Fund provides great opportunity with high single digit return in the past through management of interest rate risk. There are many funds in Kotak portfolio where yield to maturity is upwards of 8%, and they all fill in the duration bucket of about 1 to 3, which is ideal from a curve point of view. In the environment where debt funds have lost their tax benefits, hybrid schemes will become part of an important portfolio for investors. And funds like Kotak Debt Hybrid, Kotak Equity Savings, Kotak Multi-Asset Allocator Fund of Fund, with their higher upside and lower downside participation, provides ideal opportunity for fixed income investors. Kotak Equity Savings Fund is one fund which we believe will be more welcomed in clients' portfolio with fixed income orientation. In this fund, about 10 to 50% is allocation to equity. When markets are cheap, we will try to invest about 50% in cash equity. When markets are expensive, our endeavor will be to invest 10% in equity. Over last 8 years history, average equity allocation is about 10%. But in order to get equity fund status, we invest balanced money in arbitrage equity in such a manner that 65% of this fund is in equities. If cash equity is 10%, arbitrage will be 55%. If cash equity is 50%, arbitrage will be 15%. And rest of the amount is invested into fixed income to pay margin for arbitrage, as well as to invest to generate accrual income. Equity does provide higher volatility, but also provides higher risk. The taxation is of equity fund, which lowers taxation burden for higher tax paying consumers. And the performance has been fairly good with high single digit return over a period of time. With more than 2-year horizon, almost 100% of time, your returns are positive. And if someone is looking to generate more than 7% return, then with about 4 years horizon, the number is coming at 96%, 94%. Obviously, past performance is no indicator of future performance, but this data does show that this fund is capable of generating little higher volatility compared to debt fund, but substantially lower volatility compared to equity fund. And for generating that extra volatility over debt fund, it gives adequate compensation in terms of return. Kotak Debt Hybrid Fund, where about 25% investment is invested into equity, is also a good combination for retail investors. It has delivered around high single digit, low double digit return over 3 and 5 year basis. It has consistently generated positive alpha, and thus And this fund, Kotak Debt Hybrid Scheme, can be offered to retail investors as well as people who are seeking conservative risk return profile. Gold, we were bullish gold in March 20, and throughout last 2-3 years we have remained our bullish call. It worked very well in CY20 with 18% return, didn't work in 2021 with negative return, but came back to performance in CY22 with 14% return. Even for March 23 ended FI, gold is one of the better performing asset class. Gold has started going to all-time high level thanks to central bank buying. Central banks have been adding gold thanks to what happened with Russia, and this is supporting gold prices. Gold looks attractive vis-a-vis US equity, and we believe there is opportunity for gold prices to go higher over a period of time, depending upon how US interest rates move. This chart suggests that whenever US interest rates starts to come down, there is a rally in gold. And we believe somewhere in second half of 2023, gold prices should get supported by falling US interest rates. The only catch in the game is that there is about 15% plus tax incidence on domestic gold. What you could buy for $100 in, let's say, Singapore or Dubai market, the same thing will cost 115 plus in India. If tax rates come down, to that extent, there will be impact on rupee gold prices.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.